Good afternoon, everyone, and welcome to Why Compensation Alignment Still Matters in Governance. I'm Caitlin Brogan, Abernathy McGregor's Director of Marketing. Our speakers, Eileen Cohen of Abernathy McGregor and Marc Hodak of Farient Advisors, have a lot to share with you today. Before I let them begin, I just have a few quick housekeeping notes. After the presentation, there will be an opportunity to ask questions. If you would like to ask a question via the web interface, simply type your question in the Ask a Question box and click Send. And please note that your questions will not be visible to others attending the webinar, just the speakers and me. If anyone has difficulty hearing the presentation, please use the same Ask a Question tool to alert us to the problem. And also, a recording of today's discussion will be made available tomorrow, so keep an eye out for that in your inbox, and feel free to share with others who are not able to attend. So with that, I will now hand the presentation over to Eileen.
Thank you, Caitlin, and welcome all. So, to no surprise to many on this call, the number of proxy votes against compensation ticked up in 2019, particularly for companies in the Russell 1000 Index. This chart shows the vote results for companies in the large cap Russell 1000 Index and separately results for smaller cap companies in the Russell 2000 Index. Smaller companies saw a decline in failed votes versus a year ago, but failed votes rose in the small cap group versus recent prior periods. Using the same indices, we note that the number of proxy votes which received less than 75% approval, to some, a critical threshold of proxy vote support, also ratcheted up in 2019. Why is this support trend now reversing or stalling after years of record compensation vote support? One answer may be the increased scrutiny by investors to pay packages which are deemed to be outsized relative to company performance. Investors are becoming more vigilant regarding the value of pay compensation as well as the structure of reward programs. We have to take note of the latest initiative by CalPERS, which executed a 53% against vote on compensation in the most recent proxy season. Also interesting to note is that ISS vote results were somewhat similar to past years, although they did recommend voting against 11% of the S&P 500 versus 9% in 2018. ISS recommended against 13% of the companies in the broader index, the Russell 3000, the same as the prior year, but up modestly from 2015. The number one reason for the ISS negative recommendation against compensation is the pay for performance disconnect, or misalignment, when reviewing CEO pay with total shareholder return. This explanation is not a new critique and has been the number one concern since the initiation of Say on Pay.
Eileen, you got Marc here. As a former institutional investor, do you find these results surprising?
You know, Marc, I sort of do and don't. After years of shareholder engagement and even more disclosure than ever before, the Say on Pay votes reached record levels of support, but now we're seeing a reversing trend, possibly. And other issues may be coming to the fore. I continue to note, interestingly enough, that companies that receive a support vote in one year cannot necessarily bank on a support vote for the following year, and I've seen this firsthand. So there continues to be a level of disconnect, even though the comp structure may not have changed year over year. So is short-term stock performance then driving these outcomes, or are we in a short-term period where more stock is being afforded year to year under the same program? Very interesting to note, so not too sure.
Okay.
Going back, though, a key question for you in the audience is, how do you define alignment? Investors and compensation committees have spent the past 8 years since Dodd-Frank mandating the shareholder vote, attempting to define what we all mean by this term. And most of us basically have agreed to disagree. So let's just start with a basic survey question. What performance period in your mind of compensation defines long-term? And you have a few choices: 1 to 2 years, 3 to 4, 4 to 5 years, or more than 5 years. And we will just wait a few minutes to acknowledge the responses. So it is still refreshing. We seem to be, for the bulk of the responses, in the selection of B, 3 to 4 years. That seems to be where most of the votes are coming through, although it's been an even split between 4 to 5 and more than 5. So that's how the audience is defining long-term. Interestingly enough, the tenure of CEOs is declining. That's true for board members itself as well. So you can see on this chart, when we are thinking about long-term, we note that the tenure of a CEO is declining. We see here for the S&P 500, the median and then the average tenure for the CEOs for those companies, and they are declining over time. So we are losing years of service in the CEOs, but also, if you look at this chart, we are also losing tenure at the board level as well. So on this chart, you have for both the S&P 500 and the Russell 3000, the mean tenure and the median tenure for board directors. So shareholders and boards are faced with a dilemma. While long-term compensation metrics are deemed to be best practice, the tenure of CEOs as well as board members, which include the comp committee members, is declining. The chart on this page shows that difference and that decline. Rethinking the time frame as well as the mix of compensation will be required in order for compensation committees to be effective, as well as for shareholders to believe that they are voting for compensation programs which fit the company's parameters. In the end, to better define alignment for all parties. Moving forward, aside from tenure and time frame, we have a question to you as well. What metrics best define success based on your definition of the time? So we have another survey question, and the choices for metrics should include total shareholder return, or TSR plus some operating metric, or the operating metric only, excluding TSR, or none of the above. So we'll just take a few moments and wait for those results. So far, as these results are coming in, we see that more than a majority of the audience prefers option B, total shareholder return plus some operating metric. Well, Marc, based on the work and research you have conducted and addressing the responses we have just seen, please shed some light on how we can move forward towards better alignment.
Sure. Thanks, Eileen. Well, first, let me mention that Farient Advisors recently concluded some research where we interviewed 25 institutional investors from around the world. And once again, pay for performance emerged as a top concern. Now, everyone says they're in favor of pay for performance, but in my experience, people mean different things when talking about pay for performance in the context of compensation. I recall one of my engineering professors in college told me that engineering is fundamentally about problem solving, which is no surprise, but the most important step in problem solving is correctly identifying the problem. And the problem of pay for performance is one that I think is generally misidentified. For example, let's say that we are investors in a gold mining company, and our firm's management team has run the best gold mining company anywhere during a period when the price of gold has dropped significantly and shareholders have suffered accordingly. Would paying bonuses to that management be pay for performance, or would not paying them be pay for performance? And similarly, if a company's shareholders have done well, but maybe not great relative to the peers, in other words, the company and the management team is simply riding a wave, does that management team deserve a bonus? So we can depict this as a kind of a four-part grid where in the upper right-hand corner, where the shareholder performance has been strong and the management team is perceived as strong, the board sees them that way, and relative performance has been good. Should that team be getting outsized pay or bonuses or higher than average pay? And I think everybody would agree that paying them bonuses would be pay for performance. And similarly, in that lower left-hand quadrant, where the shareholders are suffering and management performance is not being seen as very good, everyone would agree that not paying them bonuses would be pay for performance. But what about those other two quadrants? Companies, in fact, find themselves in those two quadrants quite a lot, and in my experience, that's where a lot of the question marks start to pop up. And I'm curious how our audience would answer which of those two scenarios, outside of the obvious ones, would you pay bonuses for? Would you pay bonuses for quadrant A, where the company's relative performance on metrics might be good, but the shareholders are suffering? Or quadrant B, where the TSR was good, but the company was just riding the wave and the board is probably not all that impressed with what management's contributed to that? Or the other possibilities is you might pay for A and B, or you might decide you don't want to pay for either of those. So let's take a moment to see what the audience thinks about that. So Eileen or Caitlin, when things have finished refreshing,
Yeah, Marc, the screen is refreshing, and it appears that the bulk of the responses are in category C, both A and B, more than 55% of the attendees.
Okay, so these attendees are probably management and not investors. Generally, when I give this to investors, they would say they're willing to spend for A and not necessarily for B. In fact, most management teams, about a lot of the time, half the time, the management team would say that A is probably where they deserve bonuses more than B. To be giving bonuses for A and B, as well as obviously that upper left-hand corner, is something that shareholders are probably not going to tolerate for very long if you find yourself in those different situations over different years. Looking at it from an investor's point of view, as I said, their strong preference is generally scenario is quadrant A. But most investors admit that they, in fact, are more likely to support higher management awards in scenario B than in A. And that's in part a reflection of how they themselves, as investors, are rewarded. They're only rewarded when shareholder returns are high. And also because as outsiders, investors can't really know the quality of management, aside from how that is eventually reflected in total shareholder returns and the shareholder performance. Now, as I said, a fair percentage of the time, directors are going to find themselves in quadrant A or B, and with the insight to distinguish the quality of management and their performance apart from how the stock price is performed in the short term. And directors are generally reluctant to pay for 3 out of 4 quadrants. They're going to probably prefer paying for A than for B. And they have to decide what they think is best for the long-term interests of the company versus what's going to be acceptable in this proxy season to their investors.
Marc, let me ask a question. Is this more of an issue or problem that can be solved through improved communications with shareholders, or is it more of a structural problem?
I think it's a bit of both. I mean, good disclosure of a company's performance or the rationale for why they're paying the way they are is always the first line of offense when explaining difficult decisions, and it's always worth the effort to do so. But when a company performs poorly for its investors, investors will naturally be skeptical of any disclosures that talk about how great management is, especially if the stock price declines are happening over more than a year. So at the bottom of this is fundamentally a problem of separation of ownership and management. In fact, I recently had a breakfast with an activist investor who had just assumed a position on the board of a problem company. And he told me he was surprised at how much more he knew being on the board than before when he was just a disappointed investor, and how that was influencing his view of management and the problems the company was facing. So, Eileen, more transparency is better, almost always, but at the end of the day, boards may find themselves in positions where they have to make truly independent and sometimes unpopular decisions when it comes to pay for performance.
What about the concern, Marc, that not enough long-term incentive compensation is performance-based?
Yeah, so here's another situation that can confound our current ideas of what it means to pay for performance or for pay and performance to be aligned. Investors have been pushing for performance-based stock grants in the belief that they would better tie pay and performance. At the same time, there's probably also, I think, the naive hope that if management didn't always earn the stock payouts, that this would on net result in lower CEO pay than we've seen in the past. Consequently, we've seen a strong growth in the use of performance shares, or PSUs, over the last decade. And the chart that's up, shows the PSUs having grown over the last 10 years from being used in about half of the companies. These are S&P 500 companies, the largest companies. Today, they're used in about 85% of companies. So that is one of the most really prominent trends in compensation governance that we've seen. Now, as part of the Farient research that I mentioned earlier, the one where the investors say that pay for performance is the top concern, those same investors complain about the growing complexity of executive compensation. Well, the single biggest driver of that complexity over the last 10 years has been the proliferation of performance shares. Performance shares take up more real estate in the CDNAs than any other aspect of compensation.
Marc, I found this particularly intriguing, and I just want to make a comment about complexity, and it's shown on this chart here about the fact that the CDNA on average is now about 15 pages plus another 10 pages for tables and footnotes. I noted that Equilar took a survey of word count and indicates an increase of 4% since 2013 to about an average of 9,500 words. I don't believe that much of this increase is a reaction to SEC demands for mandatory disclosure, but I think more due to investor engagement and the investors' need for more clarity about how compensation programs actually work. possibly this is all adding to complexity, is also the ask by investors for more metrics than just the few we highlighted in the poll that we took earlier in the webcast. And when PSUs are involved, well then more metrics and PSUs just do add to complexity. It just explodes.
Yeah, I'm actually surprised that the word count has grown by only 4% since 2013.
Well, interesting enough to that, many companies now spend a lot of their proxy real estate up front summarizing the compensation plan even before they get to the CD&A. So there's a lot of explanation going on.
Yeah, and still a lot of unhappy investors about how the explanations are showing up for them. Well, my team and I, we did research on PSUs, and we had a couple of questions from what we just saw. The first was, did the proliferation of PSUs actually have the intended effect of reducing CEO pay? Now, I was frankly skeptical from the beginning that this pay-for-performance solution would reduce pay because shifting the long-term incentive mix from RSUs and options to PSUs tend to increase compensation risk for management. And I believe that management would react to increased risk exactly the way investors do, by demanding an extra potential reward. So we looked at the grant date value of long-term incentive awards when PSUs were the primary vehicle in the equity mix versus the grant value where companies relied solely on restricted stock units and stock options. And this is what we found. So what we're seeing here is overall a 35% cost premium for companies using PSUs. So that's the grant date value of PSUs are 35% higher. The grant date value of long-term incentives are 35% higher for companies using PSUs than for companies that are using only RSUs and stock options. Now, my hypothesis that the increased compensation risk would lead to increased compensation is actually pretty well borne out here. If you look at the sectors with the greatest premiums of the cost of PSUs versus the non-PSU awards, you can see that the riskiest industries, tech, consumer discretionary, financials, they have the highest premiums, while relatively stable sectors like consumer staples, real estate, utilities, have little or no premium.
So, Mark, many look at realized pay, not grant date pay. Is there a difference in the results for realized versus grant date?
Eileen, we've been looking at that as well. It's actually much trickier to determine. When we look at recent cycles, it appears that realized performance share awards values are slightly higher than the grant date values for those PSUs. On average, about 5%. But we've also been in a period of generally strong performance. So it's hard to tell if the higher, realized value in a strong period is an acceptable result or not. Let's take a look at that again when we've gone into a general downturn and looked at similar statistics. Now, the question of performance is, I think, key, but we looked at it in a slightly different way. We asked, how have companies with PSUs actually performed relative to their peers who didn't use PSUs? I mean, if the shareholders were getting something for that complexity and the increased compensation cost, then it would be worth it. My going-in hypothesis was that we would see no real difference in performance. And if there was no difference in performance, then why go through the brain damage of performance share units? They have to be calibrated, you have to get metrics and plan leverage and goal ranges, et cetera, in overlapping years one after another. Why go through all that? And I was actually surprised at what we found. And what we found was a statistically significant result of companies using PSUs underperforming the market. That's the dark bars underneath. And companies using only stock and options meaningfully outperforming the market. That's the lighter bars above the zero line. And we see that result here every single year that we observed.
Mark, I have to say that this is a stunning, very surprising result. Does the research suggest that alignment is better defined through the use of time-restricted units and/or stock options?
Now, I think so. When I was trying to explain what might be driving this result, the first thing that came to my mind is short-term behavior. We like to think of long-term incentives as driving long-term behavior, but the research clearly shows that stock ownership does that perfectly well all by itself. If I, as a manager, have a significant amount of my personal net worth exposed to the ups and downs of the stock price, that keeps me focused on the long term versus the short term in a reasonably balanced way. It wouldn't make sense for me to try to get a short-term bump on the stock price at the end of this year if it meant that I was undermining potentially what the stock price is going to end up 3 or 4 years hence when I'm presumably able to cash out. On the other hand, if the amount of stock that I was getting was materially impacted by how well we perform on some metric by December 31st of this year, then what happens after December 31st of this year, and who knows what's going to happen then, frankly, that's going to have a little bit less weight for me. And by the way, there's a lot of research behind those assertions. So that's what I think is probably happening is we shift from time-based grants where somebody just has to perform and watch the stock price go up as long as they stick around, performance-based grants where end-of-year numbers are going to determine how many shares they get. And by the way, the Council of Institutional Investors also found this result to be pretty surprising and important enough to modify their guidelines to no longer insist in PSUs being a majority of long-term incentive grants.
Thank you, Mark. Just to summarize what we've been discussing so far today, we've outlined some takeaways from our conversation. First, managers can do better and more specifically articulate the ways that their plans link pay and performance. Relying less on performance shares may actually better encourage long-term behavior. Board directors should continue to engage with their investors, and companies must be aware that investors are looking for reduced complexity in compensation programs. I just want to also mention that in 2020, ISS has stated that it may vote against compensation committees and board chairs, and CalPERS has said they are taking an even more forceful vote reaction next year against entire board members. So I think a lot more work certainly maybe in engagement and some of the points that we just ended with regard to companies and shareholders. Mark, I want to thank you for attending, and Mark and I want to all thank you for attending this presentation. We have received some questions so far, which we would like to address now. So, Mark, this is a question I know that is right up your alley since you worked with EVA, economic value added. So we have a question about someone wanting and preferring to use EVA with total shareholder return. What do you think of the combination of those two metrics in a compensation plan?
I like them. I mean, EVA is a challenging metric to get right in a compensation plan, and as good a measure as EVA is, I mean, I've implemented EVA plans probably as much as anyone breathing, and I can assure you that a lot of the power of an EVA plan is actually in the plan structure that it enables. It enables you to have a plan structure that doesn't require budget-based target setting. It enables you to have a plan structure that gives a share of EVA over multiple periods, so it can actually create make what looks nominally a short-term plan or an annual plan look more like a long-term plan. And the nice thing about, if you do it right, the nice thing about that combination is that EVA is an accounting-based metric. So like all financial accounting-based metrics, they're inherently backward-looking. We're looking at how we perform right up to the moment that we close the books. And it's a good measure of capital efficiency as well as operating efficiency. So if you've got a company that's got both operating and capital, components that you need to work with, It covers all those bases, whereas TSR is exclusively a forward-looking measure. So that combination actually covers a whole lot of bases, and if it's implemented well, I think it can be very good, very powerful in compensation programs.
Yeah, as a former investor looking at that, theoretically we like the use of EVA, I guess in certain industries certainly, but I do think, and I go back to some of the issues about complexity and how it gets defined and then interpreted and communicated. So there are challenges on the communication side of using it, but I've always felt that it was a good way to align incentives myself.
Mm-hmm. Yeah.
We have another question about vesting cycles. So what is the opinion on vesting? It doesn't matter necessarily exclusive for what the vehicle is for the vesting cycle, but just how long is a longer vesting cycle true alignment? I'll let you answer that first, Mark, and then I'll take a shot at it.
Sure. One of the most robust results in the entire governance literature is the idea that the more that management owns, the better the investors are. And what I think that means, the way I interpret that, is that management having their personal net worth exposed to the ups and downs of the stock price gets them to think and behave like owners. So there are two ways that you can achieve that ownership. Of course, one is you need to have stock that you've either bought into or more likely you've been awarded over time. And longer vesting periods kind of keeps your feet to the fire. But the other way of doing this, which more companies are starting to adopt, is through holding periods, longer holding periods, so that after you vested, management's required to hold a certain portion of their vested stock, in their personal portfolios. So I think that either of those works to get the benefits of ownership.
I would agree. The investor community does like longer vesting cycles and does like longer holding period cycles for stocks. Some have even suggested that holding periods go beyond even the CEO's tenure at the company. I also noticed that there had been shareholder proposals in the past that have asked for minimum holding periods of stock. And I note that in 2015 there were 12 shareholder proposals, but in 2018 there were none. So I don't know if that means we've gotten to a better place or shareholders have just given up on the issue. But I think the consensus is that they would both like longer vesting periods as well as longer holding periods.
Mm-hmm.
We have also a question. We've talked about including ESG metrics in compensation programs. The question is, what are the benefits and challenges of including those metrics in both short-term and long-term plans? I'll let you go first, Mark.
So ESG is the research that we did, and when we interviewed all the investors, and it was a global set of investors by around 4 continents. ESG figured very prominently in their governance concerns. They want to hear companies talk more about what they're doing along those lines. Climate change was a huge issue, and so there's definitely an appetite for companies to be addressing those issues and disclosing them and talking about them. In terms of putting them into a compensation plan, I have a couple of major caveats. The first one is that presumably any metrics that we put into plans, say for especially like human capital management, social engagement, things like that, those are usually presented as having a positive business case. In other words, eventually it will help profitability to be engaged in these issues. And to the extent that it does help profitability over time, I think it doesn't really make sense to add an ESG metric in a long-term plan because presumably, over the long term, you're going to have the profitability, you're going to have the total shareholder returns reflecting, good behavior, good governance, and positive corporate behavior that's supposed to represent. And besides, you don't want to have complexity. Adding any non-financial metric beyond, profitability or returns or total shareholder returns in a long plan long-term plan if that's how you structure PSUs. If you still want to have PSUs after what I've just said, it potentially adds complexity. Now, for an annual plan, most companies are going to carve out about 20% of the metric portion that's driving the annual reward for things like strategic goals, which would certainly encompass things like ESG metrics. And I think that that's okay. It provides a communications function about what the leadership thinks is important, but it does it in a well-balanced way that enables management not to lose sight of, to keep their eye on the ball.
Yeah, I think the investor community is, from what I could gather, is somewhat mixed on this issue. By the way, 27% of the FTSE 350 companies do include ESG metrics today, a lot more than I would have thought. I think to your point on the short run, identifying goals that align with the company's particular purpose makes sense. I think on the longer term, it gets a bit complicated and certainly adds to complexity in the longer term. Some of the metrics and some of the data points that are needed to prove success are hard to quantify and hard to audit, and I think that becomes a tricky piece of not just disclosure, but proof on the part of the company that over the long run they've met these goals and have identified them correctly. So I do see them in the long-term plans for investors as being a bit too complicated, actually.
Yeah,
and
I think
that's my
even
personal
in a
opinion.
short-term plan, yeah. I just wanted to, if I could add, also even in the short-term plans, this kind of gets to another subject, which I'm not sure if you got a question coming up on it or not, which is non-GAAP metrics. Whenever you're adding metrics that are non-GAAP, you have the concern about how auditable it is, and ESG metrics so far have kind of defied standardization, which makes them a little bit more difficult for investors to entirely trust in the context of a compensation plan. But again, I think your point about complexity is very well taken, and even in an annual plan, it's going to add to complexity.
Yeah, and we've talked about this offline, Mark, you and I, about non-GAAP measures. I just want to throw out a statistic that I thought was surprising, but 72% of the S&P 500 reported an adjusted EPS. It's quite a lot, and 71% reported an adjusted income number. So non-GAAP measures are quite prevalent. We know that. There is one other question I thought was interesting that came more from a governance perspective, and that is, as the interest for long-term compensation perspective, should shareholders then move from a 1-year say-on-pay vote to a 3-year say-on-pay vote? And I think that's an interesting perspective because we're going to get to vote on this again as investors in 2021 or 22, I think. But just from my perspective, when the vote frequency first was issued right after Dodd-Frank, in my prior firm, we debated 3-year vote versus 1-year vote frequency, and there was quite a few investors in the team that really wanted 3 years. We settled on 1 year, and when the vote came up again 6 years later, hands down, everybody felt that a 1-year review on compensation was the right thing to do. I have a feeling as we go into the next vote on frequency again, it will be again 1 year. From my perspective, even though we are talking and considering alignment over the longer term, investors do need a window or feel that they need a window every year in terms of how the program works. And if there have been changes in the corporate structure, either through M&A or a spin out of a company or a change in focus or a new CEO, they want the opportunity to have an opinion on whether or not the compensation program still remains valid or aligned with what they thought the year before. Any other views on that issue, Mark?
Yeah, I recently came across a company that they were a peer company of one of my clients where they were the only ones that did it, a say-on-pay frequency every 3 years. and their last say on pay vote was in 2016. Well, in 2017, the comp committee decided to award the CEO $87 million, and there was no say on pay that year. And in fact, that award was so large that they couldn't even give it under their stock plan in 1 year. They had to do it over 2 years. Well, the following year, the second tranche of that was not subject to a vote. I'm looking forward to seeing what the say on pay vote is going to be for this company, then the third year afterwards, where they're probably going to have a much more normalized pay plan. I will say that, as you can expect, the shareholders expressed their dissatisfaction by significantly reducing the vote for the directors on the comp committees in those 2 years, in these intervening couple of years. My sense is that, whether or not it's 1 year or 3 years is not as core of an issue as, how well companies behave over time, because one way or another, I think shareholders are going to have their say, either directly through a say on pay vote or increasingly and alternatively through direct voting for the directors, for the comp committee members.
Thank you, Mark. One other another question that has come in that we've discussed is on buybacks, actually, and how should management and shareholders consider share buybacks when determining compensation? I'll just give you a couple of thoughts. I just attended a forum where the investors in the room, of course, look at buybacks as a capital allocation decision and up to the company, but that feel that it should be excluded when looking at compensation if metrics are used where share buybacks would influence those metrics. Companies in the room, however, basically agreed that because it is part of the capital allocation decision, companies have a choice, and that the buyback decision is a strategic one and should be included in calculating the metrics for compensation. So kind of a investor versus corporate perspective on the use of buybacks and comp calculation. Any view on that?
Yeah, this is really interesting example of a combination of issues. One of them is that the incentives matter, which is a common theme, I think, in a lot of this discussion. And when EPS, for instance, is a part of the incentive plan, there is no question that management is going to look to buybacks as a way to enhance their pay. Now, there have been instances with clients where I've gone to management and said, that's going to raise flags. Why don't you just use net income instead of EPS? All you're doing is you're getting rid of the denominator that might create suspicion of manipulation if you have it in there, otherwise have it in there in your incentive plan. And a number of CFOs say, actually our investors want us to buy back shares, and they are happy to have EPS. They're happy to see that denominator in our bonus plan, and they don't mind us being rewarded for that. So my advice to boards is that it's just, if you're going to have something like EPS where it takes you can do a zillion things to make the numerator bigger, the earnings number bigger, and all you have to do is one thing to make the denominator smaller and therefore bump up your results. If you're going to do that in combination with a very clear strategy that your investors are favoring of share buybacks and a program for buybacks that is articulated, disclosed and communicated, so everybody understands that management is not simply, in a discretionary way, making their results look better purely for pay purposes.
Thanks, Mark. One other question that's come in, and that is, should boards actually cap the amount of compensation that a CEO can earn? I've not seen on the investor side too much clamoring for cap, but I think we're entering an environment where that might be more and more acceptable from the investor or shareholder perspective. What do you see in practice in terms of capping compensation?
I've always been skeptical of hard caps. When you look at bonus plans, annual bonus plans for a very long time now have had hard caps. That means that when you get to, say, 200% of target, then you're not going to get any more bonus. That's the end of the award. And I think that potentially is a hazard for shareholders. What you're basically saying is, above this level of performance, you're going to be in unrewarded territory. We don't really care how much better than your stretch target you're actually performing, and we're not going to reward you for that. If you're managing, no private owner of a company would do that. I've never come across a private owner that's gone to a salesperson and says, okay, you sold X amount, that's all we're going to pay you for. You can go home now and play golf. Or division manager in a private company. Owners just, they don't do that. So public shareholders, I think, would be losing out if they try to extend caps to overall compensation, especially in the long-term plans. I think, frankly, they are probably being hurt somewhat in the short-term plan, but the long-term plan is so much more money at stake, and there's no upside so far. I think it does dominate management's behavior for now. But the idea of putting an overall cap on pay, I think it would actually hurt the investors for companies to implement that. You're not going to get the same entrepreneurial behavior that shareholders say that they want to get from their management teams.
Right. Yeah, I would agree with that. Another question has come in on the issue of mega grants. So sometimes mega grants are given to CEOs, especially incoming CEOs into a new company. And we know there's been mixed reaction on these mega grants in terms of vote results. Is this a bad practice, giving out a mega grant to an incoming CEO? What do you think?
Well, no. First of all, there's a question of whether it's a good idea or a bad idea. I think that as a practical matter, investors have long rebelled against mega grants because in the year that they're awarded, you end up with these $30, $50, $60 million awards. And even if they're intended to be awards that are not repeated over multiple years, or intended to kind of stretch out over 3 to 5 years or sometimes longer, Elon Musk got basically a $2 billion grant date value option, but everyone understood this is the only thing he's getting for the next 10 years, and he only, gets to realize the upside of that if performance over that 10-year period is extraordinarily good. So I think that, as a practical matter, it's hard to sell to investors. Investors still have a tough time with mega grants. As a matter of whether it's good for investors or not, as I said, the research indicates that the more that management is exposed to the stock price, the better they tend to perform for investors. And that would indicate that the private equity model is very good, where they give those grants up front, and they're very significant grants. That's all they're going to get, presumably, until a transaction happens. And that exposes management maximally and early to the ups and downs of the value of the company. As a practical matter, when you're trying to lure a CEO in, especially a CEO of an established company, they're going to be almost certainly leaving behind a lot of money from the company that you're bringing them from. And you're not going to get them unless you make that up. And generally it's made up in the form of equity awards. And usually the equity awards will have grants, will have vesting periods to them. But you're not going to get the top talent if you don't provide those grants up front.
Yeah, as an investor who's had to look at some of these programs, I would say it's always case by case. The idea of the mega grant itself was not a negative, but it was the circumstances and who the incoming CEO might have been coming into the company that would sway how we would view the program. But we would agree overall that the size of the grant or a mega grant is not necessarily an issue, particularly if it's the payout that lasts for quite a number of years and has to be earned over that period of time. And from our perspective, in the past, that's been truly pure alignment, actually.
Mm.
So there's time, I think we have one more question, and that is really about clawback provisions. So there's a question that came in about tougher clawback provisions, especially when, let's say, a company's reputation's been tarnished. Has there been, Marc, in compensation design, changes in clawback provisions aligned with compensation, especially in recent times when we've seen a number of high-profile situations that have tarnished and really affected company reputation?
Yeah, I think that the Wells Fargo scandal in particular got a lot of people to think hard about clawbacks in the context of reputational harm, because all those fake accounts, I don't know how many million fake accounts there were. When they had to make up for that, it added up to, I think, a few $1 million worth of revenue that they had to give up to get rid of those. It was not even a blip on their financial statements, and it wasn't going to have a significant immediate impact on their profitability, and there was no restatement associated with that, so they didn't have to claw back from their executives awards that were earned due to badly stated profitability numbers or financial numbers in general. And in the end, they were able to get the senior executives, including CEO staff, to give back quite a lot of money. But the boards of directors, seeing all this, in my experience, they got a little bit of religion, and they're starting to insist on clawbacks that go beyond what are mandated, which is if there's a financial restatement, to clawbacks where if the executives are perceived to have hurt the company's value, regardless of whether it was a financial restatement or not. And I think that a lot of executives, too, in this Me Too era are trying to signal that our company is not like that. And if we have a policy against, say, harassment or something that's going to, that also has hurt a lot of reputations. We're not going to tolerate that. And the way we can communicate we're not going to tolerate that, one of the ways we can communicate that is by enabling the board to claw back pay if we hurt the reputation of our company in that kind of a scandal.
Mm-hmm. Thank you, Marc. Again, I want to thank everyone for participating today. We will conclude at this moment, and if you have a question that was not answered, be rest assured that we will get a response to you. Thank you again for joining us today.